Okay. So now we have June. I introduced you earlier, so now actually it's your time from GAIB. He's going to be talking about a new productive finance where on-chain returns are built on tangible activity, not speculation. Take the stage.
Hello, everyone. This is Jun. I'm the co-founder and CTO of GAIB. And today I'm gonna share about the data passive yield and why DeFi needs real work. Yeah. So where the passive yields come from when we're talking about in DeFi? So it usually represent the APY with the minimal effort, and it usually comes from like two parts. First, it comes from either the variable market dynamics or the token incentive. So first is like the lender interest income, right? Like borrower paying the interest to the lenders, and it's usually fueled by the leverage or some market dynamics. You want to fund something, and the most representative protocols are like Aave and Morpho. And second yields come from like AMM liquidity provider fee, right? Like doing the LP. It usually comes from like the trading fees paid by the users if they swap, and then share with the LPs. And yeah, and Uniswap curves are the most representative protocols. And the third yields come from the staking, usually the on-chain consensus rewards from different L1s. Yeah, so it actually just have new issuance of their tokens, or yeah, as their gas tokens, to the validators as the third yields. So for example, like Lido, right? You just like easily stake it to Lido, and it gives you like native yields of ETH. So these fees comes from like basically based on like different market dynamics, because it comes from either new issuance or it comes from like users and the liquidity and the markets, and then they actually trade on AMMs or borrow monies from money markets. And the fourth one is usually called like yield aggregators or like strategies or like votes, like these kind of fees. And these fees come from like yield farming or liquidity mining, right? Like these votes, like people deposit the money into the votes, right? And they will be like curators or strategists, right? They create some active strategies, and they optimize the yields on chain and move the money here and there. And probably the most representative one is Yearn. But like these kind of yields are unpredictable, right? Because the market is like volatile, and it's often subsidized by like token incentive, which means it's sufficient for long-term capital attraction, and there's no like real external cash flows. So if we want to sum it up, the DeFi native yields, it usually have like these four, like several limitations. First is like the emission-driven burnout. Let's say like if there's no like token incentive, or the price of the token drops a lot, and it will have like dilution risk, right? No one's want to like mine like tokens without any value or price. So most of the capital will just asset. And the second limitation is reflexive cyclicality. It means that it has like high beta, because it's very hard to predict whether the market is going up or going down, or whether another protocol is going to be popular or not. So it based on like relies on the market condition, and there's no correlation with the external economic growth. And the third limitation is the organic yield compression. It means when a pair on DEX goes mature, it will have like less volatility. That means there will be less people to swap on it, or there will be too many people that will LP into that pool. That means the trading fees cannot offset the impermanent loss, which means if you are an LP of that pair, you will probably have some loss if the pair's imbalanced. And the fourth limitation is the black box risk. And it usually happens to these like votes or curated votes. Because if you put money into like these curated votes, the curators will move money away, right? And then put it into different protocols. And these protocols are usually built on top of different DeFi Legos. And you actually don't know like how many Legos are in that vote, right? So there will be a lot of like composability risks. Yeah, so there are like a lot of like limitations for DeFi native yields, and in the early stage of DeFi, right, the yields will probably be like double digits, right, like 30 or even to 50% APY. So it worth these risks, but right now it's just like single digits, right? So it probably isn't worth all the risks. So how can we do that? So we need to introduce the actual cash flow, the actual yields from the real world. That's why we always heard of that like 2025 and 2026 would be the era of RWA, right? We have to tokenize real world assets and then put it on chain, right? And most of them are tokenized like usually it's treasuries or commodities or even private credits. And we can also, because like the Fed policy, and it actually has real impacts to the real asset yields on both on everything like U.S. Treasuries, private credits, commodities, and even equities. But that leads to a new questions. Oh shit. Yeah. So as 2026 is probably the era of AI, right? So how can we get the AI yields in the real world and put it on chain? How can we earn the real world AI yields? So before we talk about the AI yields, let's break the AI into like the 5-layer cake. So this is the layers like presented by Jensen. So he said that like AI can be broken down into like 5 layers. And first layer is the power and energy. It's the physical foundation of AI, like the cooling, the water, the electricity, the land resource. These are the natural resource and artificial resource that the actual data center needs to build on top of. And the second layer is the hardware layer, which is the GPU chips and the accelerators and the memories. Like these semiconductor infrastructure powering all of the AI data centers, neoclouds, and these chips are the hardware layer. And the third layer on top of the hardware is the compute infrastructure, which is the neoclouds provider, AI data center itself, large scale like GPU clusters. They actually combine these like hardwares into running facilities that can actually provide compute resource to all of the AI startups, AI companies, and independent developers. And the fourth layer, which is the foundation models, is a large scale of like pre-trained models, like different LLMs, computer vision system, and other like tuned models like for like different from different companies, and kind of like abstract the raw compute into the real intelligence. And the fifth layer, which is the layer that most people are familiar with, is the AI applications like ChatGPT, Cloud Code from Anthropic, right? And the API tokens connected by open clouds. And these are the applications which actually utilize the real intelligence to create a real world value. And what GAIB is doing is focusing on the third layer, the compute infrastructure. So what we do is we tokenize the enterprise level of GPUs and the rental contracts of these like neoclouds, and we turn it into a yield-bearing stable coins that people can just like hold it and get the yields from these data centers. So why is like different from like investing into like data centers? Because like right now for most of the data centers, they are like private companies. You cannot directly hold it, right? And for the stock that you can buy, those are like the second layer. They are like cheap in hardwares. Like for example, like Micron, like Nvidia, like AMDs. These are like stocks of like producing or manufacturing the actual chips. So it's not direct exposure to the data center and the cash flow generated by these like rental contract. So that's why we like directly tokenize the rental contract and the actual GPU racks and bring the GPU yields on chain. And in this way, we create a new type of like DeFi primitive that can be composable to other protocols because it actually generate like really high yields because the boom of AI. So the main products we have, there are like two main products. One is AID, called AI dollar, and the other one is the staked AI dollar. So for AI dollar, it's a synthetic dollar. I will call it stable coin. I will more call it like a synthetic asset. And it's backed by like US Treasury and cash equivalent. You can easily mint it with like USDC and USDT and other approved like stable coin. And you can also like redeem it at any time. We at most like T+1 due to the redemption of US Treasury. So AID is kind of like the base currency of GAIB ecosystem. You can treat it as an entry point of the tokenized data portfolios. And we are going to open another like robotics portfolio. So you will also be like purchased by AID. And the stake AID is the stake version of AID. It's a 4626 volts that you basically stake your AID to get exposed to the actual data center deal. And it tracks the net asset value instead of maintaining the $1 peg. So you will get the yields directly from the vault. And the value reflects the performance of the underlying AI data centers in their rental contract to different AI companies like OpenAI and Anthropic. Yes, if you want to get more details about GAIB, you can go to the link tree and other things cannot be displayed. So just go to the link tree. Yeah, and thanks everyone for listening.